Welcome everybody. This is George Veter for your monthly video blog for Veter Financial Group and all those that happen to come across this through referral or through one of the social media outlets. I appreciate these opportunities to give you kind of my view from where I'm at and also to give you perspective as to what we need to probably be paying attention to going forward and to connect with you in this format. It's my pleasure. So first of all, here we are in April. Spring has started and the market has stayed strong. We've had a little bit of selling, but we're still at really good levels for 2024 after having a very above average 2023 coming out of the hole of our bear market in 2022. So this is an expected expansion after a bear market that we experienced that wasn't any fun a few years ago. So I want to talk to you a little bit about where we're at and some things that I have as observations that maybe you could be cognizant of going forward as you put your mind around everything going on in the world. First of all, we have a lot to be encouraged by. You know, the three things I mentioned to everybody in your reviews as you come in is that we have really good consumer spending. We actually had wage increases over inflation last year of 1.3% as reported in February for January's inflation data and wage increase data. So people have more money in their pockets. That's an upside to inflation, is that wages go up, especially with a tight labor market. That's a benefit to working America. And then we also have really good corporate profits. We had a great January earnings season reflecting the fourth quarter of 2023, and now we're just getting ready in a little over a week to get into the first quarter earnings that'll be announced April through May. And we assume that we're going to have, another very above average experience with those earnings. That's been the trend for quite some time right now. And we have a Fed that's talking the language that Wall Street had been praying for some time. The Fed has told us that he doesn't think it's prudent to raise interest rates anymore, that the inflation data will allow him to actually cut interest rates. He said to expect he being Jerome Powell, to expect interest rate cuts of up to 3 times this year. Most analysts think that'll start in the summer, but we'll see. Depends on data reads between now and then. So that's a really good backdrop for stocks to continue to do well. Now, in this environment of expanding markets and people like their statements, as you come in for your reviews, everybody's happy because we had another good start to the year and a great year last year. But we start getting, I think, maybe some people, a distorted view of what to expect because the market has not been super even. The market has favored, or the stock market rather, has favored large cap tech. We talked, before about the Magnificent Seven and how instrumental they were in last year's stock market returns. And the theme that 7 stocks especially were rewarded for is artificial intelligence. It's kind of like the new big momentum trade. And so the last year advance was actually only responsible for a handful of companies, or responsible attributing to a few companies. It wasn't very broad. Financials didn't have a good year last year. Oil companies didn't have a good year last year. By and large cap value, dividend paying, slower growth companies didn't have a good year last year. Certainly small caps did good in the fourth quarter, but overall didn't have a great year last year. Foreign stocks underperformed domestic stocks. And bonds did good, but of course not as good as technology cap related indexes. So we, of course, get the question now, how come we're not putting more into those large cap techs? So I thought that would be a constructive discussion to have real quickly with you as far as our thinking in that direction. First of all, this reminds me of another historical period. I've been in the business for, since about 1990. So I remember the boom in technology stocks in the 90s that resulted in a tech bust, or that bubble being burst in March of 2000. Took a long time to recover. As a matter of fact, the S&P 500 had a lost decade. From December 31st of 1999 until December 31st of 2009, that 10-year period, the S&P had a negative 1% average return. So if we were excited and we were too concentrated on those styles of stocks, we were rewarded in the 90s, and then we just got paddled or punished in the first decade of the 2000s. Now, it was worse for the NASDAQ because that's where those technology stocks were more concentrated. And so we had the NASDAQ that had a negative 5% average return in that same 10-year period for 10 years. And then we had the NASDAQ 100 had a negative 6% return. So it wasn't just the small technology stocks that were phased out, that weren't real business models. The NASDAQ 100 index, the 100 biggest NASDAQ issues, actually lost more than the NASDAQ as a whole during that decade. What's interesting, though, it was only a lost decade for technology-related indexes and domestic indexes. During that same period, we had just an incredible rise in emerging markets. Okay, so we have a small allocation to emerging markets. That did phenomenally well. Value stocks did great. Those dividend-paying Procter & Gamble, 3M, Exxon, Altria, those type of stocks did phenomenal in that first decade of the 2000s. And small caps came back. So you were only disadvantaged, you only had a lost decade if you were overweighted in the popular indexes of the decade before, which were, tech-related issues. I had a big client in the Bay Area at the time, and I was responsible for their 401k. So I would go over there and I would have enrollment meetings, every quarter, because it was a fast-growing tech firm in Palo Alto. And I remember having discussions in the 90s. I was trying to help them understand why they needed to be diversified. But I remember nobody wanted to be diversified. They just wanted tech. They were frustrated with small caps, frustrated with value, frustrated with bonds. Those returns were positive in the 90s, but not as positive as technology. That was like incredible. So I would get blowback every single enrollment meeting. But then their attitudes changed dramatically in the 2000s when we had that lost decade and a negative decade for technology. And if those that listened to me and were diversified, they actually made money, and it wasn't a lost decade to them if they were properly diversified. So that time frame, I think, correlates to now. I don't know exactly what the timing of this is going to look like, but eventual overvaluation of a theme, market history tells us, eventually creates a bubble to be burst because we go too far on the upside and then we go too far on the downside. The market is not even keeled, right? It's very volatile that direction in both directions. So we want to make sure that we're not just betting on the horse that won the last race. That would be betting on just the large cap tech stocks. Now, we don't throw them out of the portfolio. We keep invested in those stocks, but we don't ignore the other asset classes. In fact, that period of time, the 90s and then the 2000s, there was a huge disconnect between small caps and large caps in US stocks. We now have the biggest disconnect in valuation and in average share price today that we've had since the 2000 bubble burst. So does that mean small caps are going to just explode? No, but they're a good value right now, so we need to have them in the portfolio. Eventually, value's always rewarded. History tells us. So not maybe on the timing that we can guess, but we know it eventually will be. So we need to have some money outside the United States. We need to have some money in value. We need to have some money in small caps. We need to have bonds that are our hedge against negative equity environments. We need to do all that. My job is to make sure that your money is as dependable and predictable as possible, your money returns. So we're not trying to hit the ball out of the fence, and of course we don't want to stink up the place. We want to be that middle ground that allow you to beat inflation and pay distributions over the time that you're in retirement and for generations to come, if we're so blessed to be able to multi-generationally manage your money. So that's kind of what was on my mind, and just know that we're committed. There's a great danger in herd mentality. We all know that, and we've heard that, but the herd usually does the wrong thing. The herd panics together, and the herd gets greedy together. And really going against the herd has been the more profitable path in the sense of investing. Know that we, being Viter Financial Group, will never be herd mentality. We will never be just trying to take advantage of momentum and trying to ride whatever's popular for the time. We're always looking at things long term, and we're resolved to stay calm and to be pragmatic and to be positive no matter what happens with the next cycles. There's a poem that you've probably heard before at some point in your life, but I read it on a wall years ago and I wrote it down. I committed to memory. This is like 40 years ago, so I think I can still rehearse it even though it's been a while, but I thought about it this morning preparing for today's remarks. And that's, there is no hope, no fate, no destiny that can circumvent or hinder or control the firm resolve of a determined soul. You work with Viter Financial Group, and we are all determined souls to get to your goals appropriately and with the least risk that we need to take to get there. And we'll always be that way. I look forward to chatting with you next month.